We are honored to have Rebecca Patterson with us. And we've known Rebecca for more than a decade now. Every time, and I said this to you before the show a couple weeks ago. I said, you're one of those people, when you come on TV, you have to turn the sound up. I mean, that's the highest compliment I can give for the CNBC, Bloomberg, Fox, all that stuff. When they see you, they want to hear. I was going to say Fox Business.
Yeah.
I mean, it's a business network, Dan.
Okay.
And you've had a storied career. So tell us, just walk us through hold
on a second, because it's interesting. You know, we met her in the green room at the NASDAQ.
Yeah.
This is 2011.
Which is a closet, by the way.
It is a closet. It's not fancy by any means. It was 2011. You were cast as one of the panelists of Money in Motion. It was a macro show. I was on Options Action.
Sure.
You were on Fast Money.
CNBC's Fast Money.
Yeah. But we got to know you then. Where were you back then? Let's talk about your career a little bit, because like you just left the largest hedge fund on the planet. You were the CIO at Bridgewater. Epic run there.
Chief investment strategist, but close.
All right,
I had a lot of responsibility.
But we didn't get to see a lot on CNBC when you were at the Bridgewater here.
Right. So backing up just for a second, I won't go to where I was born and my childhood, but I'm an accidental banker. I started out life as a journalist in Washington covering politics, then in London covering politics, economics, policy, and I was writing the daily foreign exchange column for the Wall Street Journal, and then lots of features about everything from the meetings that were leading up to the beginning of the euro in Brussels, which were a lot of fun to translate into English, by the way. Back in the day, we had lira, we had francs. It was tons of fun. And then Tony Blair getting elected, the Bank of England becoming independent. What did this mean for the economy, the markets? And in 1997, JP Morgan called me and said, we read your stuff and we think you get it and we want to hire you. And I said, I don't know anything about banking. They said, no, you know enough and we'll teach you the rest. And I thought, well, gosh, why not? If I suck at it, I can always go back to journalism. So I joined in December 1997, and you guys are old enough to know what was going on in the world then. I was a currency and precious metal strategist for the investment bank. So first week there, I'm dealing with the Asian currency crisis. Within my first year, I had LTCM, I had the Russian ruble devaluation, I had a smidge of volatility in the Japanese yen. So I had a vertical learning curve. And I did the tour of the world at JP. I was in London, then Singapore for 3 years, which was amazing. Got to see so many countries, different policies, different ways economies worked, and then back to New York. And in 2008, JP Morgan said, why don't you run a trading desk? And once again, I'm like, well, I've never done that, but why not? I'd never lived in Asia either, but why not? So I ran a trading desk during 2008 and 2009 for the private bank doing currencies and commodities. And the best trade of my career was in 2009. We went long oil on a curve of contracts to reduce the negative carry when oil was trading about $15. That was still to this day the best thing I've ever done.
I did not. So our paths have collided without either one of us knowing it, because I was
6
a commodities
degrees.
trader for 15 or 16 years. So in 97, when you started there, I was at J. Aaron.
Oh, wow.
Trading. So you remember names like this is off the rails, Dan, I know, but the Bernard Brophies of the world and the people who were trading precious metals at JP Morgan. Extraordinarily small world. So my admiration for you, which was extraordinarily high to begin with, is only grown.
Well, we'll have to have a separate conversation another time, and we can get into the wonderful world of gold. That alone could be super fun.
That is a podcast that guy would welcome here. It's funny, 1997 was my first year in the business. I was at SAC Capital, and all those events that you just talked about, I had kind of a front row seat. Again, I wasn't managing capital. I was probably like the lowliest guy on the desk there. But to see all those things, to me, that just seemed like what happened in the markets at that time. And you were new to the markets there, not covering them, not from an investment standpoint, you obviously were. And it's kind of interesting that year was smack dab in a 5-year period where the S&P 500 averaged 30+% returns. And I think that's what's really interesting when you think about it. And I think maybe we all have a little PTSD when we think about these macro events, which for me were kind of outside my skill set for a very long time, but that the stock market can keep marching on, right? That's kind of a theme that is played out over the last 25 years.
Although I do think today markets have become more interconnected. So if you see volatility in one, I think it's relatively more likely to have contagion in others because people tend to hedge across markets, not just within a market. And I think especially over the last decade, as bond markets became more global. In the past, you had treasuries if you were in the U.S., you had boons if you were in Europe, et cetera. And today, I think you're seeing a lot more people taking a global approach to bonds in their portfolio, and that creates other types of contagion. So, but I agree with you. That's fascinating. All of us, we have to have a drink after this and go into this.
So let's talk about
JP Morgan, right?
Yeah.
So I loved it. I was there almost 16 years, left as chief strategist for asset management, but got offered a CIO job at a multifamily office called Bessemer Trust. So I ran an $85 billion portfolio there for about 8 years, and it was great. I loved the clients, loved my team. Ray Dalio and I were on a Federal Reserve committee together here in New York City, and he started saying, "Why don't you come work with me? Why don't you come work with me?" And A, that's very flattering, but B, I thought, what an amazing challenge. If I want to push myself as a professional, no one's going to push me harder than Bridgewater. And so I joined in January 2020, right before COVID hit. It was a crazy time to be onboarding at any company, much less Bridgewater. And I had a great run there. I learned a ton, but I learned that I'm not an algorithmic investor. And that's okay, right? You love driving cars. You don't know if you're NASCAR or Formula One until you get behind the wheel.
I'd be a NASCAR guy.
See, I'm
because
definitely
rubbing
Formula
is racing.
One.
Yeah, no, that's exactly right.
Is racing.
I'm just saying. Please continue.
Yeah, no, that's okay. So once I realized that, I thought, you know what, life's too short, and I need to do what I truly love and am passionate about, and so it's all good. So now I am keeping busy talking to folks like you, going on TV. I have a piece coming out tomorrow in the Financial Times. I do some stuff for them.
Let's talk about the environment now because it is confusing. I know I'm confused by it, and I think you probably have similar thoughts as to, there's so many cross currents going on as we speak. So talk to us about at a 30,000-foot level, what are you seeing?
Sure. So I'm seeing an economy today in the U.S. and globally that's not gangbusters, but it's fine. It's fine. Atlanta Fed GDP tracker just got downgraded today for the U.S. for the first quarter, but it's still 1.1. Europe's doing better than expected. China had a good first quarter report. We know we did take it with a grain of salt, but things are improving there on a relative basis. And yet you think, okay, how do I square that circle with surveys of trucking business collapsing, with small business confidence collapsing, with a banking crisis, with the fastest Fed tightening cycle in 40 years? Right?
Yeah.
So I kind of feel like it's the waiting for Godot recession. That's the line that sticks in my head, that a year ago the war starts in Ukraine. You think, well, gosh, this has to end in something bad happening, especially in Europe. So recession doesn't happen. 6 months ago at the fall IMF meetings in Washington, the consensus was recession. Just a matter of timing and depth, but it's coming. And now we get to today, and I was just in D.C. a week or so ago for the IMF meetings, and they're no longer forecasting a recession.
Doesn't that make you nervous? So when it was consensus in October, the stock market was at its lows.
Yep.
And now, we're up 15, 16%. This is the S&P 500 from there. And it's interesting when you just mentioned the Fed or the GDP tracker, the Atlanta Fed at 1.1% just downgraded. I mean, when you think about that, I don't know how you avoid a recession at this point because that's likely going lower.
Yes.
We have CPI at 5%. We also have Fed funds at 5%.
Yep.
So you think about that, right? And to me, that's just the thing. And the spread between the 10-year U.S. Treasury and where Fed funds, it's saying something. So talk to us a little bit about that.
Yeah, my base case is recession probably towards the end of this year. And I say the end of this year rather than imminently. Now, look, we could always, First Republic struggling. There could be other banks that are struggling in the coming weeks. So could something break and it happen sooner? Sure. But I think base case, end of this year, because China's reopening is giving global momentum. You're seeing that in data across Asia, certainly in Europe, right? 50% of German GDP is exports. China's their biggest trade partner. So there's a spillover effect from a recovering China that's important. We're also seeing people continuing to do their revenge travel, revenge spending after COVID. International airline surveys are off the charts, back above pre-COVID levels. And now not only do you have the Western tourists going to Europe, you have Chinese tourists who are about to go out and about. So tourism's 10% of GDP for Europe. It's a big deal. So I think you could have China and Europe having a lift in the coming quarter or two. Now, the ECB, the European Central Bank, is still hiking. They're now worried about wage inflation. So that's an offset. And next year, Europe's going to tighten fiscally again. So that's going to be a drag. But in the short run, it seems like these things have a bit of momentum. And yes, the U.S. is moderating, and I think will continue to moderate. But with the consumer still relatively solid, I think they're slowing, but they're still from a solid base. Unemployment rate at 3.5%. They have incomes. They're using their credit cards. Credit card debt's going up, but their debt to income is still pretty low. So it's starting from a low base. So I want to see the consumer turn. I want to see them pulling in spending. I want to see layoffs broaden and pick up. When I see those cracks in the U.S. economy, and I think Europe will start rolling over in the fall, China will start fading in the fall or the winter, that's when it all plays through. That's my base case. But of course, nothing's black and white. That's just my probabilistic, most likely outcome.
So that's the economy, and I wouldn't disagree necessarily with anything you're saying. I'm probably a little more negative, but, shades of gray negative.
Yeah.
But what does it mean for the equity market, if anything?
Yeah, so this is what I'm struggling with because my base case is bearish on the economy. Markets run ahead of the economy, so the markets are going to start pricing it in way before we're actually looking at a trough or a recession. And so when do you leave the party? You never want to be the first because you're going to get compared to your peers at the end of the year. But you also don't want to be the last because you knew this was coming. So I guess my playbook would be to use any bounces, any relief rallies, and start averaging into some more defensive positions, whether it's sectors, whether it's names, holding some short-term treasuries at a 5% risk-free yield. Thank you. I'll take that. And we talked about gold, a small piece of gold in a portfolio. I'm talking like 2% of a total portfolio, not a lot more. Not gold stocks, very different animal. That would be something I would do too. But I would be legging into it over the coming months. So if I'm wrong and it happens sooner, at least I have some protection. And if it happens in Q3, Q4, by the time I get there, I'm going to have enough defensive positioning that I can wait out the storm.
Is there a scenario, though, where maybe, the S&P, when it was at, 3,600 or something like that, really discounts what, let's call it a shallow recession at that? I think that's what kind of Guy's getting to.
Yeah.
Because I'll tell you this, we almost got back to the pre-pandemic high from February 2020, was about 3,400 or so when, we were at those lows in October. And it felt pretty panicky at the time. And the consensus, to your point, really moved towards a recession in the first half of 2023. And then I think about the NASDAQ, and I think about today, we're recording this, it's, Wednesday into the close, the second largest stock on the planet, Microsoft, is up nearly 8%. So it's a $2.2 trillion market cap. It's trading at new 52-week highs. And when you think about that, the S&P is down 0.5% on the day. And if you look at the equal weight S&P, it's down more, and it's much further away from its recent highs. So there's a lot of underlying weakness. If you look at the small caps, the Russell 2000, it's down on the year. It's down 2% or so. And then to your point about defensives, people are buying what you're selling because staples are acting pretty well. We just saw Coke, Procter, Pepsi. We saw the pricing power that they have, but that only works for so long, especially if the economy starts weakening. And so I guess, is there one data point? Is it unemployment? What are some of the data points that would kind of maybe say, all right, the S&P does have a chance of going back and retesting if I see the acceleration, let's say, in a couple of these metrics?
Right. So historically, and I think it's still valid today, once jobless claims start moving, they keep moving. Companies get nervous. They say, okay, we've got to tighten our belts just to have dry powder, to have some cash on our balance sheets in case demand drops off a cliff. So jobless claims, and it comes out weekly, and it's hard data. It's not just survey data. So if I could only watch one thing, I'm watching that. The subcomponents of the monthly PMI surveys, business confidence surveys, I think are really, really telling. They don't give you a lead per se, but they give you maybe a 1 or 2 month lead, and they tend to be really well correlated with multiples. So I would definitely keep an eye on those two to try to maybe I'm not ahead of it by a lot, but at least I'm not missing something. Consumer confidence is really interesting too, and we're seeing this in the U.S., but also overseas. Current views of the world, kind of like we're talking about, are okay. Expectations are falling very hard. And historically, you tend to see that things are all right now, but they're going to get worse. Those trends tend to accelerate going into recessions. And so watching that to see if it continues to accelerate, those would be big ones to me. But the last thing, and the one reason I think it's not priced in enough, is the Fed funds discounting. I just can't get by that one. The fact that, I mean, the market's moving a little bit here and there, but we're basically still looking for a sustained easing cycle to start over the course of the summer. And the markets are discounting that. Which
I don't understand. I mean, the unemployment, I don't know why we would need to cut rates with a 3.5% unemployment. It makes zero sense. But the fact that people are saying that, and if we were to cut rates, something really bad were to happen.
Correct, which would hurt earnings. If something bad happened, earnings would go down.
So that's not the panacea I think that people think it's going to be. I'm very simplistic in the way I look at some of these things.
No, we know.
To me, I know you know. CPI to me equals inflation. PMI to me equals economy. So you can have a shitty PMI and people might get all excited thinking that somehow makes the Fed's job easier. But it actually leads to an environment that Danny Moses talked about for the last 2 years of stagflation.
Correct.
Economy's shitty. Inflation is stubborn. Are we there?
I mean, inflation is coming down. It's not coming down as fast as the market would like for the Fed to start easing, especially shelter we know is coming down. It just lags. And then the one that's trickier is wages. We need consumers to stop spending on services so those service companies stop hiring and fighting and pushing the wages up. When that happens, then maybe we can get a Fed easing cycle. The stagflation risk I worry about more is medium term. I've been spending a lot of time thinking about the energy transition as we try to take care of the climate for our kids and grandkids. And, the transition, it's a longer conversation, but I think the transition itself is stagflationary. We can't get renewables online fast enough to make the changeover without a lot of volatility between A and B. And I think that volatility is going to include periods of higher commodity prices. Demographics, to me, is likely to be stagflationary. And I'll recommend a book for your listeners. Charles Goodhart, who was at the Bank of England, wrote a demographics book and I don't find demographic books, my usual exciting Friday night bedtime read. This was a great book, great, well-argued book, and I bought into it. I think that there is going to be a wage pressure because we have a mismatch between supply and demand of workers. And at the same time, because we have so many dependents relative to workers, we're also going to have to spend more money on taking care of our parents and grandparents who aren't working. And then we're going to have even harder fiscal trade-offs. I mean, I think there's a number of things. The war, the friend-shoring, home-shoring, whatever we want to call it, that's definitely stagflationary. I mean, the fact you guys are following what's going on with TSMC and the subsidies they're asking for to build in Arizona, the cost we're going to spend on getting chips here versus Taiwan, we're getting the same supply of goods at a higher price. Hey, guess what that does? So I think stagflation is a risk over the next 3 to 5 years, not material. We're not talking about 70s, but a higher inflation rate and therefore probably a higher interest rate than what we've had over the last decade. The era of free money is over.
Yeah, and if you're waiting around for that Fed funds to come back to zero, you're waiting for the wrong thing. So we all agree, and that has really been the playbook, right, over the last, call it 15 plus years. How could your base case for a recession, base case for, let's say, lower valuations, because stagflationary environment would really put pressure on equity valuations. We can agree on that, right?
Yes, definitely.
And so how do you square this week? And we just mentioned Microsoft. And listen, I listened to that conference call. Satya Nadella, it sounded like the go-go years of 2019 or something like that. I mean, literally, they sounded like everything's a go there, okay? On the flip side of that, yesterday, UPS was down 10% on a disappointing quarter and guide. Whirlpool was down on a disappointing result. Cleveland Cliffs, I mean, these are like, kind of hard economy sort of things. They're kind of pointing to a different environment than our large tech platform companies are. So how do you square that? Is there a scenario where you could have a continued, consolidation into these 10 names that are kind of, I don't know, maybe they just do better in some of those demographic issues that you're talking about or whatever, and maybe they benefit from inflation in general. So I'm just curious how you think about that, because they were the first ones to get hit when the Fed signaled that rates were going higher at the end of 2021. But it's interesting, if you want to bookend it to where we are in 2023, they're acting really well right now.
Yeah. I mean, the bounce we've had in some of the mega tech probably was from, positions getting wound down in 2022, better valuations. So some of it's mean reversion. Some of it is probably hype around AI. But I do think there is something about investors saying, where can I hide? Where is it going to be safe to put my money for the next 1 year, knowing I'm not sure how this goes? And tech, as you guys know better than I do, the companies are cyclical. There is a consumer demand element and a business demand element, but there's also organic growth. And historically, when you've had slow growth but not a recession, the big tech names tend to do super well. It's a great quality place to hide out, but they don't hold up if we have a hard landing historically. But I think right now, since the jury's out, is it a hard landing, a soft landing, a recession, a deep recession? It seems like a safe place to hide. And one thing I'm wondering about, and I don't have a good answer, I'm pondering, over the last cycle, over the last 10 years, the amount of capital in ETFs has exploded, right? They're bigger. You're smiling. You've obviously thought about this, or maybe you've already done the research.
I've thought about it, and I've not done the work you've done. But please continue.
All right,
we're
both pondering. But it does make me wonder, and maybe this is the wonderful green light for active single security selection again, but with so much, call it 401k money in ETFs, and they're mainly sector ETFs or style ETFs, is that something that keeps support under some of these tech names that just didn't exist 10 years ago? And is it a reason they might stay higher for longer, even if the cyclical demand element is starting to fade?
I think that's a great undertaking. It's something, and you should do the work on it. What I've said, and I'm not suggesting I'm right by any stretch, but over the last 5 years, when passive investing has become sort of the norm, money flows into the market regardless. It has what's happening, these conversations have no bearing whatsoever. And my concern has been when passive becomes active, it ain't going to be on the way up. It's going to be on the way down. And that, to me, is a concern. So I think a lot of people have done extraordinarily well with these instruments, but I got to tell you something. It's elevated a lot of companies that probably shouldn't be at levels that they are, and that has to get washed out at a certain point.
And it's an amazing environment for people who are picking stocks and going on CNBC or wherever else to talk about what stands out to them. I have to think in the next 12 months, this is going to be a stock picker's dream.
All right, so you were a chief investment strategist. Now you are doing a whole host of different things here. What's it feel like? I mean, because it's definitely been an interesting, let's call it, 14 months or so since the start of January, I guess the start of 2022 here. You're not in the sort of seat that you were over the last, call it 10. And what sort of perspective does it give you about the markets, right? Because I'm sure you're talking to a lot of smart people besides us right here.
No one's smarter. No one's smarter.
No, there's plenty smarter. I'm just curious, what sort of perspective does it give you, not sitting on a desk with all the sorts of resources and all the calls coming in and all that, all the inputs and everything like that? Does it give you a little bit of clarity about some of this stuff?
I'd say there's pros and cons. So the pro is that I don't have infinite numbers of internal Zoom meetings to talk about what's going on within the company and some project I've been voluntold for. So I'm more productive because I don't have to spend time doing those things that are important to run a company, but that's out of my life for the moment. And you don't have the distraction of them. So you have more time to do some deep thinking, which is amazing. I can look at something like the Russell 2000 and say, okay, small caps are down twice as much as the S&P since their relative peaks. Do I buy here or do I keep selling? What would I do? And then I can just dig into that for 3 days straight with no interruptions. And that's awesome. It's such a luxury.
It sounds like she's just YOLO and puts all over the place. You know what I mean? Like,
but
why wouldn't she?
But the con is, chatting to someone next to you saying, hey, what am I missing on this? Or can you help me build this chart better? Or, help me brainstorm about something. So, I mean, Bridgewater, one of the things that was great about it is that you debated like you were a bunch of 6-year-olds. Why? And it gave you better answers. And so there's a pro and a con to being out of the formal.
Being non-dogmatic. I mean, I say it all the time, dogma stifles debate, and debate's the only thing that leads to change. And, when we get sort of, and I'm guilty of it all the time in terms of the markets, but you try to get out of that. But in terms of not trying to be dogmatic and really look at what's going on before we get out of here, the banks are fascinating right now. I mean, we can't leave this without talking about what's going on. And I don't want to play stock market, but just sort of the landscape is changing extraordinarily quickly.
My big fear is for the smaller and regional banks in the U.S. because I think they are unsung heroes in the sense that your community bank knows the local businesses. They're able to do good diligence because they all play golf together or whatever. And so they can make loans. And the huge mega banks they don't have the time. Not to say they ignore the little guys, but they're focused on the big elephants, right? They don't have time to make a million tiny little loans. It's just not the right business model. And so these little guys play a really important role for the economy, for the financial system. And they're going to be facing greater regulation. They're going to have to carry more capital. It's going to hurt profitability. I think there's a good chance we'll see a wave of mergers and consolidation. And then I wonder, what does that mean? Is it going to affect the small and medium-sized businesses around the country? Is it going to be a small deal or a big deal? How quickly will it play out? Will a recession exacerbate it? That's the thing with the banking system that's keeping me up at night more than anything else right now. The whole thing about how do we attribute the blame for Silicon Valley or others? Yeah, okay, there's supervision, there's regulation, there's boards, there's management, there's the Fed. Probably everyone had a role, but to sit there and pick, well, he or she were the worst, I don't know how useful that is. I do wonder if we could have gone back in time, what should we have done differently that could have prevented where we got to? And how do we do better next time now that technology is allowing people to move over $100 billion in 36 hours, right?
Yeah, that's crazy.
It was 40-something one day and over 100 the next day. That's like, wrap your head around that. And regulators have to not only keep up, but get ahead of it for the next one. How are they going to do that?
They won't. Because they haven't. If you think about it, right, like the lessons of the financial crisis. I mean, people were yelling and screaming about all the regulation that came in the years after, and if we hadn't had some of the framework in place that for COVID, can you imagine some of the issues we would have had? But then, in the lead up to that, some of the restrictions on some of the regionals were taken off for political reasons, that sort of thing. So, we're destined to kind of, suffer the same failures again and again. All right, before we get out of here, you were on CNBC's Fast Money last week, and you had this great bit. You were talking about a project that you've been able to spend some more time on since leaving Bridgewater, and your former boss is actually helping you out a little bit. So you want to. You're launched a program. You want to talk about financial literacy. Tell us a little bit what you're doing and how Ray Dalio is supporting you to do it.
Sure. Very happy to, and thank you. So it is amazing to me, given that everyone listening to this cares about what the economy is doing, cares about the financial markets, is trying to make good investment decisions. And yet half the states in the country don't require that graduating high school seniors take even a single class in economics or personal finance. So a huge part of our GDP, if you want to think about it that way, is financially illiterate. And that's just embarrassing. I mean, for a country that was built on capitalism and innovation and entrepreneurship, it's embarrassing. You have to start at a state level. You have to get state legislatures and governors to pass a requirement, and then you have to teach the teachers. So I had the luxury of getting to know a woman named Nan Morrison, who runs a nonprofit in the U.S. called Council for Economic Education, or CEE. I'm the chair of the board today, and we're trying to train teachers. We provide a ton of curriculum for them, all free, of course. We train students directly. We train their families together with the students, because often the parents don't know, right? So they can't help at home. And then we advocate. We go to all the state capitals and we say, hey, don't you guys want to do this? Let's explain it to you. So there's a lot we're doing to try to move the needle. And what Ray Dalio very generously offered was a private lunch with him and up to 3 guests, and he's our auction item this year. So it's he's a big believer in financial literacy. He basically has told me over and over, Rebecca, it's the most important thing. Period, full stop.
So how can people find what you're doing and support your organization?
So Council for Economic Education is the largest nonprofit focused on this in the United States. We've been around almost 75 years. So our website, you can donate there. There's some volunteer opportunities there. The Dalio auction closes this Friday evening, I believe the day our podcast is going out. So you might be able to get a bid in. But, to have lunch with one of the most interesting financial thinkers of our generation and a guy who built the world's biggest hedge fund from scratch.
It's pretty dope.
It's pretty cool.
All right, so Guy, do you want to offer up to have a cup of coffee with Guy Adami? What would that go for? $5 or $6?
I was going to say $8.
Price the cup of
the
coffee.
If Buffett goes for a couple million, Ray Dalio's got to be in that ballpark, I would think.
Well, Ray, right now, we'll call him a value stock from that respect.
Noted.
All right, so get in there, check it out, people.
Yep.
This is going to drop Friday morning, so you're going to have time if you want to go have lunch with Ray Dalio in support of financial literacy and Rebecca Patterson's efforts. Go do that. We're going to tweet out all the details, so hopefully some of our folks will get in there and bid on that.
That's so nice of you to talk up. It's important.
It's
we
really
all know
important.
it's important.
Yeah, it is.
Slam the shit out of that like button, by the way, Dan.
All right, well, there we go. All right, Rebecca Patterson, we really appreciate this is the first, hopefully, of many appearances on the tape. Thank you for coming down and speaking with us.
Oh, it was fun. Thank you, guys.